All right, good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for March 22nd, 2014. We have a market that is still in bullish normal conditions on an annual basis using the weekly RSI 14. We're at the high end of neutral at 66 out of 100. On a 10-day basis, using the 10-day NDX, we're right in the middle of neutral with a score of 48 out of 100. Looking at the market mosaic, we're price relative to the 200-day moving average is yellow bullish at 8.28%, so we have about 6.25% cushion to sideways channel. The slope of the 50 is yellow neutral at 0.23. ADX is still at the low end of neutral at 20.5, so lack of trendiness in the market. ATR percentage increased just slightly to 1.01%, although it's still in the middle of the normal range. The risk index is the 30-period moving average of the VIX divided by the 10-period. Scores greater than 1 are risk on, and scores less than 1 are risk off. That's the threshold score. That reading right now is at 0.96, so we are in risk off conditions, meaning that riskier assets are not favored for the next 30 days worth of performance. The Z-score of that reading is when we take that score of 0.96 and compare it to the last 5,000 days, find the standard deviation, and then there's Z-score that comes in at minus 0.57. And this histogram here is a 90-day time series of that risk index, or the risk Z. And you can see that after topping out here at +1, it's decayed down to minus 0.57. So this is still pointing towards riskier short-term market conditions where volatility could be expected to increase. No change in the blended monthly rebalancing. These are the current holdings with the next change due on or about 1 April. Still dominated by the U.S. And then when we compare or we look at the leaders right now using the blended monthly rebalancing for these different portfolio choices, these are the current leaders right now. Small caps, mid caps, and U.S. real estate for ETF 13. Basic materials, healthcare, and small caps in the ETF 22. Agriculture, basic materials, and healthcare in ETF 32. And these are the top 5 and 10 of these different populations, with the Dow 30 being supplemented with Alcoa because it's a long-term trading favorite. Our ETF2 model, the theoretical exposure is at 60%. There were 2 positions that were hit for stops this week, and that cash will be maintained as cash. The model portfolio there will be at 80% exposed. All right, this is the blended monthly rebalancing, just taking a closer look at the components using the blended monthly rebalancing. Still dominated by the ETF 13, is still dominated by the U.S. assets, with Japan, Latin America, and emerging markets at the bottom on cash positions. The ETF 32 portfolio, again, still mostly on buy signals, but we have the globals at cash and emerging markets and below on cash, and still the top positions being held by all the U.S. indexes plus agriculture. It seems to me you could explain that by pointing to the uncertainty in the Crimea, putting concerns into the markets about Europe. And the emerging markets have already been weak, so that could explain why maybe capital is flowing back to the U.S. and looking at these larger caps like materials and healthcare for a momentary safety. In the ETF Max, these are the, oh, why isn't that changing? Yeah, there we go. In the ETF Max, this is about 13, these are the top 50 out of 1,300 ETFs, dominated right now by coffee, Egypt, solar energy, commodities, carbon, gold explorers, natural gas. So it's really all the real assets. Shifting to the market health check next. Still waiting for that to come up on your screen. There we go. Sorry for the delay. All right, so the vertical blue lines represent 10, 20, and 30 days worth of look back. The horizontal red lines represent support levels that were once resistance levels at key price levels, which either will act as support or would be price targets on the way down if price collapsed here. What the dark blue shaded area in the middle is the 30 period Bollinger Band plus or minus 1. That's the river. The lighter blue shaded area is the floodplain. That's plus or minus 2. These outer red lines are the plus or minus 3 Bollinger Bands. You can see how the volatility in this trending period has collapsed as price has reverted to this channel. We have price in the upper half of the river. It's come back from an extreme move here and has been consolidating with support at 185, which is right at the Bollinger Band main where you would expect in a bull market that is stabilizing. So that's not a bad place for it to be consolidating after the move from 173 to 189. It's still holding above 184 comfortably. We are still in what I think of as the green zone, an area where I want to be long, and so any evidence of resumption of the trend, I will get back in that direction intraday quickly. We have 3 regression channels drawn here in the blue. This is the short-term 10-period RAF regression channel. It's basically flat, as you would expect with price at the Bollinger Band main. The 30-period channel, lagged by a day, is still sharply up, although not as steep as it was before. You can see this sine wave looking indicator here is the slope of the 30-period regression line through time. You see it peaked right up here when price was up at 189. This sideways channeling has caused the steepness of that slope to roll over a little bit, in much the same way that the dragon, which is the 10-period Bollinger Band, plus or minus a half, this shaded pinkish red, that has also rolled over as well. So we have price stabilizing here. The 30-period is up. The 30-period slope is still more sharply up than the longest regression channel, which is the 90. And with price right in the middle of all 3 regression channels, we have a fairly priced market. And despite those large red candles, they're offset by large white candles. This is natural channeling sideways behavior where the market is stabilizing, either waiting for more news. This is not unhealthy. This will give us an opportunity to to play the resumption of the trend to the north. If it gets above 189, it's off to the races once more. And we've got solid support at 184, 182, and 180. It wouldn't be until I see price break below 176 where I would want to automatically be taking the short side of trades in the indices or the large caps, and that would represent a violation of the Dragon's swing low here, a violation of my Z minus 3, and then that would put us into sideways channel conditions anyway in the market health check. So right now we have a pausing long-term bear that's stabilizing at a logical place and hasn't really given back much of this powerful rebound move here. The jaws of PPO, the price percent oscillator, are still open to the downside, although that is actually improving, as you notice from the histogram. And then the Williams percent are stuck right in the middle of its 10-day price range. And the bulls are in charge in terms of ADX. And with the ADX below 20, what that says is if we were to get a price move back above 189, that would be sustainable for a long period, because with ADX that low, this is not an already trending market. It's been pretty choppy the last 14, 15 days. So there is room for it to have another leg up. If we see another leg up, we could be looking at something like this move from 176 to 184, or an 8-point move, or a 16-point move like this one here. So that's a move to the upside here could get to 195 on a technical basis without any difficulty. On the downside, we got price levels at 82, 80, and 76 to shoot for, and that would still keep us inside this yellow zone, and with the larger upward trend still in place. So buy on dip opportunities is what it's looking like to me. Moving on to the ETF2 regional report. I'll let that come up on your screen. Horrible lag. Sorry about that. So the ETF2 Summary Report, 6 out of the 10 regions are on buy signals, 4 are on cash. So that puts the theoretical model at 60-40, which is a slight improvement over last week's 50-50. The S&P at 54 is still better than EFA at 50, which just went into the yellow. And inside the U.S., the outperformers are technology, small caps, and then mid caps. And the two strongest sectors are technology and small caps, so the risk on trade in the U.S. And then the two weakest sectors remain Latin America and Japan at 42 and 40 respectively. Inside the U.S. sector spiders, it's still utilities and healthcare and materials in front, while energy, staples, and discretionary are lagging. Next up is the world market model. I'll wait for that to come up on your screen. All right, inside the U.S. markets, everything is above average except for the Dow, which is slightly below average in the yellow. In Asia, Japan is really lagging. Asia less Japan is below average, with the subordinate countries of Indonesia and Vietnam dominating, followed by China, Australia, India, and Philippines above average, everything else below average. Latin America, the emerging markets, the rest of the Western Hemisphere except Canada, just getting crushed. Europe is a mixed bag now. Spain doing well, but now only a few countries still above average. Inside the other asset classes, we're seeing some of the alternative classes doing better. Gold, silver, treasuries, U.S. real estate, and private equity. And then in the business sector comparisons, really it's a slight advantage to the U.S. across the board. A few cases of ties like materials and energy and healthcare, but otherwise the U.S. Is ahead in all of the other business sectors. Here we're going to shift to the daily report for Monday because of the lag. Okay, here we are with the Dow Tactical. We have a couple that fire on the RSI2 value with Nike, which is also number 3 on max pain range compression, and which is a channeling and an overreaction. And we have Merck, which has a 4 on RSI2. Both of these were percent losers, as you can tell from that their symbols were highlighted. Merck has is number 5 on the MPRC. It's a triple screen and a channeling. But other than that, not much to choose from in terms of patterns. We do have McDonald's firing as a channeling, and Caterpillar and Johnson & Johnson were both percent winners on Friday. So both are in the stronger sectors of healthcare and basic materials. So any additional follow-through strength there would not be surprising and could be very useful. Caterpillar has the advantage of being a doji and 3.1 on the frog quality number, and with a frog standard deviation of 40 cents, you can build a reasonable position size if you start seeing that move intraday. Shifting to the ETF Tactical next. And I'm going to finish up with that one. The lag is just too horrible right now, so I don't want to keep you too long listening to the silence. So I'll wait for the ETF 30 to come up on your screen. There we go. So we have Japan and silver and DBA all as RSI2s. Now that's of interest because silver and ag have been very strong leaders lately, and they test out well on the auto framer, and they are RSI2 candidates. DBA has the added advantage of being channeling and an overreaction candidate. Gold should be of interest. It's at 5.8 to 1. It's a triple screen and a channeling and an overreaction. And with 35-cent intraday sized frog box here. The VIX is of interest. It's a 551W and it tests out at 2.7 to 1 on the reward to risk. Now let's see if I can. Let's see if the charts of interest will come up for us any faster. Okay, so we'll just take a look at a couple charts of interest. This one is XLV, which has been a dominant sector in the among the sector spiders for the S&P, and it had quite a remarkable sell-off and closed poorly. And so with that close well below that previous swing low in the Dragon, this is either a changing of the regime, which is hard to believe in XLV, the healthcare, or it's an opportunity to get in at a fair price. I think XLV is going to be on my short list of candidates. We want to look at DBA. DBA has had an exceptional run these past few months, and so this could, we've been tracking, for example, swing trades in the exchange traded note CORN, CORN. So let me let DBA come up on your screen, and we'll take a look at the end of that run. It's really had 2 sharp days of selling. So this has been, these are all daily charts. So the last 25 or 30 days has been a heck of a move in DBA from 25 to 29. But now we've had 2 harsh days of selling in a row, almost at the Bollinger Band mean. That's certainly the place you want to make sure that no more of that win escapes. And so this could either be a buy on dip opportunity if we see it keep going, and that's where anything above about 28.70 would be an auto buy. But really, any resumption of this trend in here would be a good way to get in front of that. On the other hand, I wouldn't let any profits escape that were if you had entries earlier than 28. And that would be the same as symbol CORN. We'll take a look at CORN next. CORN has actually been weaker than DBA. Okay, here's corn, and you can see that it has had its nice move from that sideways quiet channel around 30 up to almost 34.5. And it has been stabilizing and pulling back much like DBA has. Again, I wouldn't let it get below the Bollinger Band mean. I would want to preserve this form of the move inside here. And then anything above 34.25 would be an automatic re-entry or adding to those positions. And with the lag we're having tonight, we're about 30 minutes into it. I'm gonna cut it here. I'm gonna record a couple more case studies of some of the YM, what I've been calling the flow series, the intraday trade sequences in the Dow Industrials futures contract. There were some really nice intraday trends that were very tradable this week, and so that's the presentation that I'm gonna make in at the end of May and first week of June at our Kansas City workshop, and so I want to give you a taste of that now. We still have slots available for that. If you're interested, I think the list of topics and the people coming so far are already excellent, but we've got room for some more people that if you want to come. I'm going to do more instructing, I think, at that one than I have in other ones because of the number of people coming, and we'll be looking at the RLCO and the FROG results of the research project. So I think there's going to be a lot of good things discussed at that workshop. So if you're interested, send me an email at longke@yahoo, and we'll get you added to the list and get you going. So that's everything I want to cover tonight. You guys take good care, and we'll see you in the chat room. Keep your risk measured and your powder dry.